Hey everyone, Joe Stenevec here, Certified Financial Planner. And in this video, I'm going to talk about Social Security taxation. Woo! Riveting. But first, if you like this video, subscribe to my channel so you get notified every time I post a video. You just hit the subscribe button down at the bottom and you will be notified when I post my weekly video. So, whether you realize it or not, there is a good chance that the majority of your Social Security, if you're taking Social Security, the majority of it is being taxed by the IRS, for the federal government. Good news, California does not tax Social Security, but you do get taxed by the federal government. If you are married, filing jointly, if you're modified adjusted gross income, and what I mean by modified adjusted gross income, the calculation works like this. Not taking into consideration deductions, so like mortgage interest or property taxes, anything like that. You cannot include that in your modified adjusted gross income, which you use to calculate taxable Social Security. Modified adjusted gross income is basically your gross income plus tax-free interest. So if you have a municipal bond, you're not getting taxed by the federal government on that, or you're not being taxed by the state of California potentially either. But it does get factored into the calculation to determine whether or not your Social Security benefits are taxed by the feds or not. That's not all though. You also need to factor in half of your Social Security benefit in that calculation. So if your modified adjusted gross income is $40,000, and then half of your Social Security benefit is another 12, that's 52, 85% of your Social Security is taxable. That's married filing jointly. So there's only so many things that you can do to stay under that under the $44,000 plus half your Social Security in terms of being able to be taxed on less than 85%. One thing that comes to mind is Roth IRA distributions. So if you have a Roth IRA and you take a distribution, it's not taxed as long as you meet specific rules, but assuming you meet those, it is not taxed. Does not go into the modified adjusted gross income calculation. So you could, if you have a retirement plan with work and it's in pre-tax 401k, for example, or you have a pre-tax IRA, an IRA that has not been taxed yet, you can start converting that over to a Roth IRA and build up those Roth dollars with the anticipation of the strategy being you want to have enough Roth dollars to try to avoid bumping your income up above the 85% Social Security tax threshold. Just a thought. That takes a lot of planning and paying some taxes up front, but there could be some significant benefits if you deploy the right strategy and get to the point where there's enough Roth dollars at some point during retirement that you can live off of. You could potentially bring down your taxable income, or modified adjusted gross income, I should say, and therefore get less than 85% of your Social Security taxed by the federal government. If you have any questions, feel free to reach out. And again, like the video, subscribe, get notified. Happy to chat. Take care. Have a great day.